Have you ever wondered how fluctuations in the Japanese currency affect the global economy? The Japanese currency is one of the most traded in the world, and its variations can have a significant impact on financial markets and economies all over the planet. But do you know why this is? In this video, we'll explore how the volatility of the Japanese currency affects the global economy. From investments to international trade, we'll analyze the factors that influence this volatility and how you can benefit from this knowledge. If you're interested in better understanding how the global economy works and how the Japanese currency fits into this scenario, then this video is for you. The Japanese currency, known as the yen, is one of the main currencies traded on the international foreign exchange market. Its importance is evidenced by its widespread use in global commercial and financial transactions. The history of Japanese currency dates back to the 19th century, when Japan adopted the gold standard and established the yen as the official monetary unit. However, it was only after the Second World War that the yen became an important currency on the international stage. The Japanese currency has been known for its stability and security for decades, making it one of the most attractive currencies for investors, traders, and the financial market. However, it is also affected by internal and external economic and political factors such as the Bank of Japan's monetary policy, the country's economic growth, and international relations. In addition, the yen is widely used as a reserve currency, along with the US dollar and the euro. The volatility of the Japanese currency is influenced by various factors, including the Bank of Japan's monetary policy, Japan's economic growth, international relations and foreign trade, as well as global political and economic factors influencing not only the Japanese currency, but the currencies of various nations. However, with exchange rate fluctuations, the risk involved, and the uncertainty of the financial market in the face of government decision-making, global events, and other factors can affect the value of the yen in relation to other currencies, making it less attractive to some investors and traders. To understand the volatility of the Japanese currency, we can cite the carry trade as an example. This is a mechanism widely used by professional investors who try to make a profit based on the difference between the interest rate of two countries. This type of operation usually has a strong impact on the exchange rate, affecting the price of the dollar against the yen, for example. So understanding how it works helps us to understand exchange rate fluctuations, which can affect investment decisions in the country, which ends up directly and indirectly affecting the country's overall growth. The carry trade is a way of looking for opportunities to profit from the difference in interest rates between countries. Takes out a loan in a country with a lower interest rate. They then convert this money into the currency of another country and invest it in an asset, usually a fixed income security, which will earn them a higher interest rate than the country they borrowed from. They then make a proportional profit by paying off the liability, the loan in this case, and pocketing the difference. From the 1960s until 1983, when the property bubble burst in Japan, Japan was considered one of the fastest growing and most developed countries in the world, even rivaling the United States. Since then, Japan has gone through decades of economic stagnation and deflation, and this long period of recovery has been called the lost decades. The Japanese stock market in Tokyo, the Nikkei, only regained its all-time high, set in December 1989, just in 2024, a long 35 years of time recovery for the Japanese financial market. The economy stagnated in deflation for decades. Family wages were flattened, hiring was reduced, and debt increased exponentially. At that time, many Japanese who had the finances chose to allocate their savings to savings rather than to risky investments such as shares, funds, and so on. This traumatic moment molded Japanese society to spend and invest its money wisely, with a society spending less, either through household spending or corporate spending. The government tried to use its flexible monetary policy, lowering interest rates to encourage credit, discouraging fixed income activities, since this would encourage capital to be invested in productive capital, greater wealth generation through spending, consumption, hiring, etc. Given Japan's history of deflation, the Japanese central bank has maintained negative interest rates since 2016. Investors saw an opportunity to borrow money in Japan, convert the yen into dollars, and invest the amount in other countries with higher yields than the Japanese interest rate. One example of a country where this capital was allocated is Brazil, an emerging country and the largest economy in the Southern Hemisphere and Latin America. Right after the pandemic, Brazil faced with its fiscal and budgetary problems, increased its interest rate to 13.75% per year. The rate has now fallen to 10.5% per year, a rate of return that is unmatched in any other country. The amount entering the country would be invested in the purchase of public debt securities. Whether short-term or medium-term securities, the rates are attractive to any investor. As a result, dollar outflows from Japan are quite high, which puts pressure on the Japanese currency, causing it to depreciate not only against the dollar, but also against other strong currencies. This effect of the currency's decline occurs at a time when countries with strong currencies are implementing interest rate hike policies, which causes a massive flow of capital to leave low-profit countries and go to more profitable countries. The Fed raised us interest rates to 5% per year, which in itself caused the yen to depreciate. With an influx of dollars back into the United States, the market uses carry trade operations according to changes in countries' interest rates, and these movements impact the global economy. However, once the Japanese currency has an increase in interest rates, contracts and loans made in Japanese yen have their costs increased, leading borrowers to return to Japan with capital. Some sell their assets on the market, causing share prices to plummet, converting dollars into yen and honoring their debts. As a result, many investors dismantle their carry trade positions and move on to new types of investments. In addition, Japan may suffer not only from monetary and exchange rate issues, but also from price shocks for inputs and commodities, since the country is not self-sufficient in many material aspects. One of them that we can mention is the price of oil, and how this can affect Japan's economy and exchange rate directly and indirectly. In addition to causing inflation, with a higher energy cost, Japan needs larger sums of dollars to buy its goods and inputs. This greater demand for dollars, in contrast to a net outflow of dollars, can raise the price of the currency, since the net inflow and net outflow, exchange flow, can become balanced or even negative. The volatility of the Japanese currency can affect the foreign exchange market in several ways. It affects demand for the Japanese currency and consequently its exchange rate. It influences investors' and traders' decisions regarding the Japanese currency and other markets. It can lead to a reassessment of risks and opportunities in the foreign exchange market. For Japan, a country highly dependent on exports, a weaker currency can have immediate benefits. Japanese products become cheaper for foreign consumers, which can increase demand for cars, electronics, and other goods made in Japan. However, the impact is not one-dimensional. A weak currency also has side effects, such as increasing the cost of imports. Japan is a major importer of energy and raw materials, and when the yen loses value, the prices of these goods rise, which can hurt local consumers and increase inflation. Furthermore, the volatility of the yen has a major impact on global financial markets. Investors, especially those holding yen-denominated assets, may face losses due to the currency's depreciation. On the other hand, when the yen suddenly appreciates, foreign investors who are exposed to Japanese assets may see their profits squeezed. This creates constant uncertainty in financial markets, which can affect investment decisions and capital allocation around the world. The impact is also felt in economic policies. Japan, led by the Bank of Japan, has implemented an extremely loose monetary policy in recent years, with negative interest rates and stimulus programs to try to combat economic stagnation. However, the depreciation of the yen is also linked to these policies, which raises concerns about the possibility of a currency war, as other economies try to compete with the Japanese currency in a race to devalue their own currencies and gain a trade advantage. Let's discuss strategies that governments, companies, and investors can adopt to mitigate the effects of this exchange rate instability. As we have seen, the volatility of the yen can be a double-edged sword. While it offers opportunities, it also creates uncertainty and risk. So, how can we deal with this reality? The first point is asset diversification and hedging. For investors and companies, one of the most effective strategies to mitigate the impact of exchange rate volatility is diversification by distributing investments across different currencies and geographic regions. The risks associated with the fluctuation of the yen can be mitigated. In addition, the use of financial instruments such as futures contracts and currency options, known as hedging, can help protect assets against unexpected changes in the exchange rate. These contracts allow a company or investor to protect against losses arising from a devaluation of the yen, guaranteeing a fixed exchange rate in the future. While this may involve additional costs, the security provided by protection against foreign exchange risks can be critical for those who have large exposures to the Japanese market. Secondly, it would be the adjustments in the supply chain. Companies that rely on imports or exports with Japan can also adopt strategies to minimize the impact of yen fluctuations in the supply chain. One approach is to restructure sources of supply. Instead of relying exclusively on Japanese suppliers, companies can diversify their sources of raw materials or components to reduce the risk of relying on a volatile currency. In addition, negotiating long-term contracts with suppliers that involve regular adjustments based on currency fluctuations can also help stabilize costs. Third point would be monetary policies and government interventions. On the Japanese government side, one approach would be a careful handling of monetary policies. The Bank of Japan has used an ultra-low interest rate policy to stimulate the domestic economy, but it also has to consider the global consequences of its decision. To mitigate the adverse effects of yen volatility, the central bank could, under certain circumstances, adopt exchange rate interventions. Interventions seek to stabilize the value of the yen in the international market, buying or selling large volumes of currency. However, this type of intervention should be used with caution, as it can provoke diplomatic tensions or result in even greater volatility. Fourth point, economic diplomacy and international coordination. In the global scenario, international cooperation is also an important strategy. The volatility of the yen not only affects Japan, but has repercussions in several economies, such as the United States and the European Union. A more coordinated approach among major central banks and governments may be needed to avoid global economic imbalances. This can involve regular consultations, the creation of dialogue mechanisms, and the implementation of economic policies that seek greater stability in the foreign exchange market. In conclusion, the volatility of the Japanese currency is a complex phenomenon that has global effects, both positive and negative. For investors, companies, and governments, the challenge is finding ways to deal with this uncertainty, protect their economies, and at the same time seize the opportunities that arise. Strategies such as asset diversification, foreign exchange protection, supply chain adjustment, appropriate monetary policies, and economic diplomacy are critical to mitigate the impacts of this volatility. However, the real key to dealing with the volatility of the yen and other currency shocks will be the ability to adapt. We live in an increasingly interconnected world, where currencies are not only instruments of exchange, but also signs of global economic forces. Volatility can bring risks, but it can also open doors to innovation and growth. Thanks for following our video on the volatility of the yen. We hope that this content has provided a deeper understanding of the subject. Continue with us for more videos about the great economic challenges of the 21st century. If you like the content, leave the like, comment on what you think, and sign up for our channel. Bye. See you next time.